Take a look around, say hi to those people. Welcome, I'm so glad you're here. I love seeing all these new faces. My name is Justin Myers. This is my partner, Cory King, and we lead Grid Knoxville. So,
what's up, y'all? Hey. Good to see everybody. Thanks everybody for coming on out. Feel free to come gather around, grab your seats, grab some food, grab some drinks. It's good to see everybody out this week.
Yes, we got plenty of seats, tons of seats up in the middle here. All right, so this is August 2025, and you are joining us for How to Syndicate Deals, the Art of Raising Capital. Welcome to Grid Knoxville. We are streaming live. So, Cory, who are you? Why are you here? What are we doing?
What are we doing here? What is life? What is this? Cool.
Yeah.
Hey, everybody. My name is Cory King, co-host here for Grid Knoxville. I'm also the managing partner for Casa Knoxville, which is our local real estate sales team. I've been an investor now since 2009, where I bought my first house. Learned the house hacking, AKA roommates strategy, before that was really a term, right? Used that to save my money and just continue to grow. I moved here 7 years ago or so, and then just really jumped into the agent side of things, started investing from there as well, and just been accruing properties, doing about, 3-4 flips a year now. Look to aim to buy about 2 properties per year, and that's just the journey I'm on at this point now.
Cory's got 3 little ones under 5.
I'm a Taurus as well.
So Owen is about to start kindergarten tomorrow.
Is mind-blowing.
Did you go to kindergarten orientation?
Yes.
Yeah, anybody been to kindergarten orientation? Kindergarten orientation explains a lot about how the country works. I was there, I was like, how can it possibly be an hour for kindergarten? No wonder why these shockingly beautiful 23-year-old teachers get married in 3 years and leave. Like, the amount of nonsense you put them through to play with our kids is insane. Like, not that they're not teaching, but I was like, this is insane.
Truly.
I remember that vividly. My daughter starting her senior year, so I'm on the opposite end of the spectrum.
Yeah.
Yes, but I can still remember kindergarten orientation where I was like, how? How is this? I love teaching kids, but how is this an hour
That's right.
of orientation?
Truly.
Log into Zubumafu for their schedule. Anyways, if you don't have kids, you'd understand if you went. It's very silly. So Cory's got 5 kids under 3. Amelia Bedelia is at home taking care of those 3 boys.
Yeah.
Right?
Yeah, we're able to really hit that point. We call it like the income flip, right? Where your passive income starts to offset your active income. And as we hit that point was where we were also at a point in the family where it allowed the wife to step out of work for a while, stay at home, and we're just going to continue the journey, which was really, really cool. Mm-hmm. Yeah, that was a lot of fun.
So I like to share that because when we talked about investing, someone is in here today. Where's my friend Sandra? Sandra's here. And we were talking about so much of investing is like, what's the goal? What kind of life do you want to build? Mm-hmm. There's a lot of ways to do this. What kind of, do you want to manage properties? What's your risk aversion? What's your timeline to have success? Are we trying just to raise cash flow? Are we trying to, do something more passive and have a longer term investment? I'm excited for what we're talking about tonight because it's a very different strategy. For someone that wants to be a little more hands-off or is more risk-averse, this can be a really great strategy in that you kind of can hedge some of your unknowns. So what is Grid? Grid is a global real estate community started by my partner, Rob Chavez, 17 years ago. Started running an investor meetup, still runs on the first Tuesday of every month in Reston, Virginia. Reston is just outside DC in Northern Virginia. It's actually the first master-planned community in the country. Really, really cool place. They did, when master planning was a new idea, what they did was just build a lot of different types of housing. Like, so you've got townhouses and you've got single families, like all kind of integrated into this community around like a central town square. Really, really cool design. We are in 10 states across the country. I've got the privilege of being the director of expansion for Grid. So I started as a mortgage broker in 2005 when I was 23. Never had any credit myself, started doing that, had a front row seat for that kind of exploding. And I've got to sit in a lot of seats in the real estate industry. From the operations side of a lot of different facets of the industry, so the mortgage side, property management, commercial auctions, residential, ran some teams, started some side hustle businesses. I've tried a little bit of everything before I finally decided to get smart and focus and talk this guy into being my partner. Right? And then started just plugging in connections. That's actually what happened. Cory and I were on a team. Yep. We both had left to pursue some opportunities. And I said, Cory, what if we just went and partnered with a big franchise? I've got the connections. I've met the best people in the country. I'm a big believer in like being intentional about who you learn from. So I'm sorry, it's the best you could find, but I was like, if I'm gonna go take content, I'm gonna go take content from the people that like wrote the book or are teaching this. Like, how do I get in that room? Because what I found is like when I get in a room, like who else is in the room really matters. And so we built some relationships. And I share that to say, like, we're not gurus, we're just people doing deals, right? We just got back from Cleveland. We just launched a location there. If anybody is interested in another market, if you feel like Knoxville's too expensive, people in Cleveland were telling me how they own 10 properties. That was like normal. And then he's like, yeah, but Justin, you don't understand. When I moved here, properties were 15,000. I bought four in my first month. Yeah, right? Someone there was like, oh yeah, I buy multifamily at 30,000 a door. In Akron, I buy in Kenton at 40,000 a door, and there was a little tiny hotel investor, and he just bought a property, a motel for $2,000 a door.
God.
It was Patel magic. Sure. It's not available if you're not a Patel, but it was still like magic. I was like, what do you? But he's the one that told me the story that when he moved here, he said, hey, I was making good income, right? And then what I did was, I wasn't trying to like get into investing so I could flip or have more cash flow. I was already making 130 and houses were only 15 grand. So I went and I bought one, and I was a young single guy. It made some sense. So one of the things we teach about, I thought might be interesting, Cory, is when you come to Grid a long time, every month we're taking you on a journey to explain the life cycle of being an investor. So at the beginning of the year, we started off with some of the basics. We do an investing 101 every single month. Right? Whereas, do you want to meet Travis up front? So next Saturday.
That's right. Yep,
Travis is going to be teaching Investing 101. And if you want to catch up, if you want to get kind of an orientation for understanding some of this, syndication is a more sophisticated topic. We kind of walk through those other plays and how to think about investing, how to understand investing. And I share that because there's two different concepts. It's your cash machine and your wealth machine. And when I came in here, like I needed more cash, right, Cory? Mm-hmm. That's what was interesting about investing. That's what's interesting about flips, and you were flipping lots, right?
Mm-hmm. That's right.
When you first got started in 09, that was a cash machine play, right? Like I need more cash. I'm not trying to like hold these long term. It would have been great to own now, right?
Yeah, that was a killer deal.
Yeah, because what were you buying them for?
So I found a side hustle then. This is 2010, 11, 12, buying lots at auctions in Central Florida and flipping those to neighbors. So I was finding lots in subdivisions that had crashed in the crash. Builders went out of business. And so I could find those strategic lots between people's houses. House, vacant lot, house. And I'd buy those lots for about $3,000 and then go flip them to the neighbors for like $8,000. Because it was a straightforward sale. Hey, who's most apt to buy this but the next door neighbor? Bring out Zillow says it's worth 10. Will you take 8? Economy sucks. I thought I was going to build whatever, and like rinse, repeat over and over again, which was a lot of fun.
Yeah. It's 160% return on your investment. You feel again like, man, I'm the best investor in the world. What are those lots like worth? Like
40, recently? 50 now. Yeah,
right? Totally. But like opportunity cost, like I don't have the capacity to sit on those things for all those years. And so I think it's helpful when we talk about cash machine versus wealth machine. Investing 101 gives you a really good idea of kind of where am I there. Does that make sense? Like maybe if I'm looking at flipping or wholesaling or any of those plays, I'm really trying to build a cash machine. For us, it's real estate sales. We sell real estate to fund our real estate habit.
That's right.
Right? And wealth machine are those longer plays where it's like, cool, Cory's like, I'm broke again. He said, no, it's because we went and bought like an asset and put a down payment down.
Yes.
And like I feel, broke. Investors are always broke
always.
Because you're always trying to come with money for deals.
That's right.
But I think that's helpful because one of the things we're talking about now, like syndication, is more of a wealth machine. And so when you're talking to other people, get a feel. Are they somebody who's like, they work over in Oak Ridge and they've got an amazing W-2 and they're looking for a place like, where do I invest my excess cash? Or are they somebody who's like entrepreneurial and maybe I need to replace my W-2 or I'm looking to get, right, I want to get into something that's more active. I'm building a cash machine. Because that'll kind of give you an idea of who am I collaborating with and where are they on the journey.
That's right.
Yeah.
Yeah,
I think we don't talk about that enough, and I think when we've reworked the education on this, and I think it's very helpful for being like, I thought I was here to invest, and I really actually need to go figure out how do I make more active income, right, before I start running some of these plays.
Right. Yep, absolutely.
Yeah, I think it's fantastic.
Yeah.
We got some wins we want to shout out?
Absolutely. I want to kind of take a minute, just celebrate some wins. Who's got a win they want to share just in the last 30 days? This can be personal, this can be business.
Dalton's got something very cool he's working on. Sean, go.
Yeah, we just closed 72 units in Panama City.
Hey.
Let's
Very
go.
nice. We got a Vacant deal accepted for 96 units here in Knoxville that we'll be building. So we might talk to you guys about showing some more information about that.
Cool.
Yeah.
Absolutely.
$35 million deal.
So LIHTC is low income tax credit. So that's, the government incentivizes their tax credit programs available where you can go out and provide affordable housing, which we desperately need. So I'm very excited to hear that, Sean. That's amazing, right? And then the government is going to come in there. They're going to provide some tax credits. They're going to make that deal work, right? Where you can do this set. You don't have to just go build, right? Squeeze the most possible out of this. I can afford to go provide some normal housing for teachers, firefighters, right?
Yeah.
Government workers, normal
That's huge.
folks.
Yeah.
Yeah, it's fantastic.
I got a win. I just finished my third flip of the year. My goal was 4. This year, number 3's down, so I'm on the hunt for number 1, which was awesome. That was really, really cool to be able to get that done. And shout out to Kent Garner there, too, for being just great co-op. We brought fire, like, the power of rooms like this, where just collaboration, everything can come together. So, thank you.
Yes. I've got one. I've got 2, actually. We're going to come up here. But Zara, stand up real fast. I don't know if everyone knows Zara. Zara just joined our team. She just burned the boats. She was the #1 salesperson in her industry in the entire Southeast. And she said, nope, I'm going to go all in. I want to be an agent full time. So,
Huge win. Good job.
yes. All right, come on up here, buddy. Slide up here. Anybody not know Vernon Quorum? Anybody that's well, some brand new folks, I love it. So Vernon is a long-time listener, first-time caller. Vernon's been coming to Grid for quite a while. We got into business with Vernon. He joined our team. Really, really excited. Vernon went through. We got a ton of training we put people through to become a Grid leader, and Vernon just got approved to become a Grid leader because we got some plans for him in the future.
So if you know me, you know I eat, sleep, breathe, bleed short-term rentals. And it's what I do every day, all day long. And we were at a coffee shop one day, Justin and I just having some coffee, and I said, why not? And he said, why not? Because what I found is that I used to watch these guys, and I was talking to Justin about it today. There's a highlight reel. You guys see these guys. What you don't know is that guy's a machine, okay? He's a machine. And this guy here is one of the most, I don't know, you can just talk to him about anything. And not that I can't talk to Cory about anything, but I'm just so amazed by kind of what you see up here is not what you get. And behind the scenes, I've got to witness these guys, witness what they do. And I'll just tell you guys, what you see is what you get. They're good dudes, okay? I love my brothers. That being said, when we talk about my event, my event is Thursday night, the last Thursday of every month. We're meeting right now at the Fountain City Lions Club in Fountain City. It's near Fountain City Park. We do the STR, Knoxville STR playbook. We truly try to focus on Knoxville. Last month I had my good friend Brian Cataldi over here to talk about his investment journey. If you want to talk to anybody.
Brian was amazing. I want to get him here to come for the entire group. It was a really incredible, unique journey into STR investing, into dominating a niche where no one else is going. Just great perspective. Sorry, Brian, but grab him, pick his brain if you're interested in SDRs. Like, what he's built out there is very cool.
That's my dude right there. He knows his stuff. And this month, has anybody heard about the big, beautiful bill? I don't care about your political leanings.
Yep.
What did they reintroduce in that?
Bonus appreciation.
Okay, so I've got a CPA coming. His name's Charles Shapiro. Super cool dude. Super nice guy. He's going to come this coming Thursday night. I don't know what day it is. I should know that. But the last Thursday of the month, last Tuesday of the month, it's on the slides. And
Yeah.
we are going to have him come and talk. And you can listen to him talk for about 30 minutes, and then you can listen to him pick his brain. I'm going to talk about my trust system, and I'm going to talk a little bit about my 7 M's that are the growth strategy for every STR. Every STR needs a marketing plan. Every STR needs some sort of makeover, on and on. So I'll talk about all those things. That's a good time for you to come and meet us and get to know us better. But Grid is incredible, and I'm so glad to be a part of this team. Thank you, gentlemen.
You're so welcome. Yeah. If anyone else is willing to get up here and just fly through their teeth and give us a glowing endorsement, you too can become a Grid leader. Just talk about how great we are. We're very susceptible to flattery, apparently. Thank you, Vernon. That was very,
Thank you,
very
Vernon.
kind of you. Yeah, so awesome. Some good wins. Let's get going. Let's get rolling. We got some new folks in here. There we go. So, cool lineup. If you can't read, anybody else can't read small print anymore? This happened to me this year. I was in the movies. You know, I got like 20/10 vision, and I was like, I was at Cinnabar, and all of a sudden I couldn't read the menu, and I was like, oh, this happens so quick. 42, like, and then it never comes back. So if you can't read this one, we're gonna run through the individual ones.
Yeah.
Cool.
Yeah. Next up, Travis has got next Saturday.
I can't read that date either.
That's okay. I'll open it. That's next Saturday,
No one can.
August 16th, 10:30. It's going to be at our office there in Bearden. We always every month we always do investing 101. It's a good spot. If you're just getting into it, you just want to learn. It's a fun place to work through. Smaller group, work through some of the basic concepts and procedures. We've got Nathan Bort helps co-host that as well. So great lending resource, great knowledge base.
We're a big believer in frameworks, right? We try to keep them really simple because in the heat of the moment, there's a reason why we talk about like the 70% rule when we're doing flips, right? Because everyone can remember 70% of after repair value minus renovations. That's the offer you make. Like that's more useful than like having like an incredible diagram you can't recall in the moment. We're going to give you some really good frameworks on understanding how to approach and orient yourself towards investing. And then Nathan and Travis are going to go through and break down the numbers of a couple deals live, go super deep, walk you through them. If you haven't spent time with Nathan, highly recommend that. That guy's a guru. That is over at our office. All that stuff is on our meetup site.
Sorry.
Then we're doing, Grid Coffee, Donut, and Deals. I'm excited about this one. Has anybody been to a Grid Coffee? What do you think of the coffee there?
Excellent.
Excellent. Andrew Ellis has opened a physical location. Anybody know where Union Place is?
Bearden.
And Toddy's and the little karate studio. I guess if you're more athletic and a drinker. It's right over in Bearden. It is right behind Backdoor Tavern on Carr Street. He's opened a coffee lounge. We're having our next coffee, donuts, and deals in the coffee lounge. Yeah.
What's the address?
What's the address? It's on Meetups on Carr Street.
114 Carr Street.
Okay.
This is literally says 4 facts.
Sounds still good.
Yeah.
I'm good.
You'll be good, and then one day you won't.
But that's always a good event to get together. We're usually pitching some deals, underwriting some opportunities that come across our desk, and always tasting some really killer coffee as well.
If you're impressed by the speaker tonight, Jeff is going to be there, kind of breaking down a deal and going deep in one of the deals that he's raising capital for. If he's not for you, the coffee is unbelievable. You got to see the way he's decorated the space.
Yep. And then August 26th, 6 p.m. is when
Yep.
we're looking for.
But the easiest way, I know we got lots of stuff. Meetup.com is the easiest way to track down. Meetup.com/grid-Knoxville. Search Grid Knoxville in there. That I think is the easiest way to find all the events. Using the Facebook group and everything else. Just there. It's got the addresses. You can RSVP. Click for directions. All that good stuff. They got an app. It's really cool.
That's right.
Thanks to our sponsors. So where's Nate Frederick?
Sitting right here.
There
Yes. So if you need some private money, speaking of raising capital, Nate at the Approach can take care of you. We already introduced Jacob Lay a little later. Want to thank Foundation Morgan. Morgan likes weird loans. You can see his little weird loans wanted. Yes. Yeah. Fantastic. So you need Nate and you need Morgan, right? I need Nate to acquire stuff that's not going to pass traditional financing, and then I'm going to need Morgan to exit that property, right? How am I going to refinance it? How am I going to get in there, or how am I going to do a conventional purchase? I want
right.
both of those people.
Yeah.
Cool.
Thanks everybody from there.
All right, who's brand new? I saw some new people in there. Who's new? Wants to
Yeah,
introduce
brand new.
themselves. What's your name? What do you do? What brings you here?
I'm retired.
Oh, cool.
Military.
Yeah.
Yeah, I'm brand new to real estate. I'm just kind of poking my feet in it, and going to find some investors and get my stuff up off the ground. Nice
Awesome.
to meet you, everybody.
Yeah. We're glad you're here. It's a good community of people. We're gonna meet Jeff here in a second. Who else is brand new? Paul?
Paul Humphreys, owner of State Farm here in Knoxville. Just interested in learning more about investing and kind of broaden my horizon. 4 years, celebrated 4 years in June.
Okay, fantastic. That's
Nice
awesome.
man. Congrats.
Dan, welcome. It's your first time here.
First time to get to be here, but I've been knowing you fellas for a little while now. I like what I see. I am a licensed realtor, but I am a beginner real estate investor as well, looking to wholesale and do some fix and flip.
Good. Glad you're here. Anybody else want to be brave and introduce themselves before we jump on? All right, fantastic. Who's got a deal, by the way? You got any wholesalers in the room? Anybody got a deal they're looking to move? We've got a couple right now that are pretty interesting. Somebody hit me up, 1.3 million. It is a sixplex opportunity, so 5 1-bedrooms, 1 3-2. The cash flow upside on it is pretty interesting in the historic district of Maryville. Holler at me afterwards. You anything, Cory?
Yep, I've got a short-term rental cabin up in the Smokies. It's currently generating about $44,000 a year gross. It's available for a subject to purchase for a rate that's sub 4% right now. So if you're interested in that market, give me a holler. Happy to chat about it.
I got a 12 unit over in Harriman that I'll sell for 1.3 with the potential like retail little area next to it.
And Sean's got, if you know somebody that's looking for a primary residence, Sean's got a property coming on the market next week. So, holler. All right. Who else got a deal in the room? So why don't you come get afterwards? Jeff's got some deals. Yep, I love that. Who's got capital?
Broke.
Who's shy? I'm looking at lenders right now that are like, no, you're not going to raise my hand. I got too much business. I see you guys. It must be good. I love it. You said you're broke. Who's a contractor in there? Who's a vendor who's looking for business? Zach, Dunright Holloway. We got Joey back there. All right, we got Will. Will is new. Will is going to go out on his own, hang a shingle as a plumber. That's old. So if you need a plumber, you might want to go talk to him. Who doesn't need a plumber?
No doubt.
Right? Fantastic. And who are my beginners in the room? Who's just here to learn? Yeah, if you see them, go shake your hand, make them feel welcome, say hi. Glad you're all here.
That's right.
Awesome.
Yeah. Yeah, cool. Well,
Okay.
yeah, we'll do a couple giveaways really fast. Who thinks they traveled the furthest to get here today? We've had folks from Italy was the farthest, I think.
Italy's
we've had
my-
on the
Italy's
planet.
my
I don't know if
favorite.
anybody
What about
really
Hardin
beats
Valley?
that, but- All right, so who beats Hardin Valley?
I started last week in China.
Yeah.
Brave the mean streets of Hardin Valley. I see a hand back there.
Yeah,
What's your
for
name? Hope.
Hope.
Where are you from, Hope? Carnes.
Okay.
Carnes is from Maryville. I love it.
Okay.
People are like, I'm not going to let.
Tom, Jefferson City. All right, who's further than Jeff City right now? I'm in the room. Go once, twice. Sold. Tom, cool man.
To the man from Jeff City. All right.
That's cool, man. We got you. We got like some grid shirts. Get with we. Raise your hand. Good, right there. Get with that guy. Hook up for sure.
We will get you hooked up. We got some sweet grid gear.
That's right. Yeah.
All right.
What I'd like to say too on this, right, is use this as an opportunity. I was talking with my friend Tom over there. Like,
Use this as an opportunity. Post on social. Tell people what you're doing. What we found is like when you put things out there like that is when people know how to reward you in there. So take some pictures. Tag us on social media. We'll do some giveaways here later on tonight. Right there. Hi. Right. By doing this, what you'll find is if you're able to tell people what you're looking for, they know how to reward you in that. Right? So you got like, my name's Cory King, I'm an agent investor, and I like to buy in 37921, 37912, 37918 zip codes. You got vacant land, single family, multifamily, holler at me, those are the areas I like to buy. What we found is when you're actually loud about this, when you tell people what you're doing, they know how to reward you. Some of the most successful investors that we've met say that a lot of their deals come just through things like that. Just telling people online, getting on Facebook, hey, here's what I'm looking to do, here's what I'm looking for, and the opportunities flow their way. That's part of why we built this room, right? It's been amazing to see the deals that happen in this room, the businesses that have formed in this room. It's powerful, so be loud about it. Tag us at Grid Knoxville.
And if you don't want to buy houses, but you like free stuff, tag us.
Yeah.
We'll stop in there and we'll give some stuff.
That's
We'll
right.
give some
That's
stuff
right.
away. We
Yeah.
got some cool stuff.
That's right.
All right.
Yeah.
Don't sue Cory.
Yeah, don't sue me, bro.
He's got 3 beautiful little kids. Don't sue us. In all seriousness, right? Trust but verify. Run this information by some trusted advisors. The state is very clear that we are realtors. We're experts on the market. We're expert on selling property. We're not experts on foundations or appraisal issues, legal issues, home inspection issues, tax assessments, right? Any of that stuff. Like go get that verified. And if you are here, we are shooting some content. You are being filmed. There was a release when you came in. Thanks so much. Cory, ready to get started?
Absolutely.
All right. What is real estate syndication?
All right.
Why are we here?
Yeah, so we are here, right? We're here to talk about syndication. What is that in reality? Well, This is in essence, real estate syndication is just a partnership between individuals or several investors, typically combining their resources, capital to go out and take down larger opportunities. So if you're not able to go buy or if you're wondering how people will go do these multi-million-dollar transactions, oftentimes it's because you're combining skills and resources and knowledge in order to be able to go do this that they otherwise would not be able to.
By our powers combined. Anybody else grow up on Captain Planet?
Oh yeah, absolutely, absolutely.
Better catch, you know.
I love it, right? So, why is syndication interesting? So, has anybody been to how to wholesale? Anybody remember wholesaling? Anybody? Right? What wholesaling is I get something under contract, and then I can go around and I can market my interest in the property. So I talk to Eric, I decide I'm gonna buy the property. Maybe it's a little bit too much for me and I wanna go sell this to somebody else. There is it's legal in the state of Tennessee. Senate Bill 909 is what you wanna look up on how to do this. But there's a legally recognized method where I can go assign my equitable interest in the contract. So wholesalers aren't realtors, they're not selling real estate. They are selling their equitable interest in a contract. Does that make sense? That's how they're able to do that. That's what it is. It can be a very useful strategy if you're looking at a lot of properties, even if you don't like wholesalers. Often you'll find that is what's happening in a transaction. We work with a seasoned investor. I decide that I'm gonna buy a property, and then maybe I go talk to Sean or Jeff or somebody, and we end up, me and Cory are gonna take it down together.
There you go.
So I assign it from myself to this other entity. It's pretty common. Syndication is very similar, right? And Jeff's gonna be able to go through this, but in that, when you go into raising capital, there are lots of rules and there are lots of regulations. You know, whether you're selling securities or something else, these are regulated by federal and state regulatory boards, right? When it comes to syndication, because of the structure, it's a way for me to raise capital without selling securities, right? I am selling an interest I'm selling a partnership piece. I am not selling a security or a stock or something else. Does that make sense? That's why it's the good and the bad. It's regulated differently, which can be great for us. It can be also challenging in that you don't have those regulatory frameworks to protect you that you do have in some of the other structures, right? Which is why things go sideways.
That's what they can.
Yep.
Fingers crossed they can, right? But certainly can. But it is a great way for you to be able to go and raise money from strangers.
Yes. And the short version of this is that I could go start a fund, but often if I look at the fund restrictions, again, that's another avenue for me is I can go start a fund tomorrow and I can start a fund and I could raise money from everyone in grid. And it could be easy to establish. I've got a relationship, you know me. Yes, Sean.
I don't mean to correct you, but actually in a syndication, you are selling a security.
Okay. Thank you.
That's why it's regulated by the SEC.
Don't take money from strangers.
Don't remember the part where I said don't sue me? So you can sue Jeff though. Jeff does no disclaimer. Thank you, Sean. So we'll go back to that. So separately, when I'm going to go start a fund, one of the reasons, so I know a guy started a fund locally. He was able to start that fund. He was a broker and a team leader for a real estate team, and he was able to clearly identify, hey, I'm going to go raise capital for this fund from everybody that has been a real estate agent in this brokerage. There's a clearly discrete set of people that I have a pre-established relationship with that I can go and raise funds from that is different from the regulatory restrictions around raising funds from strangers. And beyond that, ask an attorney. I just know that you can get into, I have seen people prosecuted for selling securities without a license when I was down in Florida. Real big mess, condo. They were selling they had preferred shares, like Class A shares and Class B shares, and I was reading through the lawsuit trying to figure it out. It definitely does go sideways sometimes. So syndication allows you to sell stocks to strangers. Accept funds from strangers.
Right.
There we go.
I was going to say, so diving into it, right? SEC Regulation D in there. A set of rules and exemptions allows companies or individuals to raise capital or selling those placements in there. These investors do not need to be registered, oftentimes with the SEC in there. So there's a distinction there between those pre-existing relationships versus if you're doing a large-scale capital raise, then we're looking at more of accredited investors.
Yeah. Let's go back to that one, though. So, you know what? We're going to circle back to this when we get Jeff up here. Does that sound fair, Jeff?
Sounds fair.
Okay. We'll talk about this. So
what accredited investors versus non-accredited investors?
Okay.
Because I think it's where things can get a little separated between the two in terms of your funding. Would you agree?
Yeah.
Right.
Do you want to go back to the slide we skipped? Or do you want to just run through it when Jeff gets up here? Let's run through that when Jeff gets up here. We can talk about accredited versus non-accredited. Okay. Yep, so what's an accredited investor, Cory?
Yeah, really it's just going to be, let's see, accredited investor makes over $200,000 a year or $300,000 a year. A married couple has a net worth of $1 million, not including their primary residence. So if you meet those criteria, one would be considered an accredited investor. If not, a non-accredited investor. Sean?
There's been,
Yeah.
the big beautiful bill changed this a little bit, and so they changed the regulations. I can't remember exactly what the changes, but the bill, the deal sponsor can certify that somebody's an accredited investor now.
Interesting.
Why would they want to take that risk?
What's that?
Why would they want to take that risk when there's third-party credit investors, like third-party companies that will credit the investor?
If you've got somebody, okay, so you've got a guy who's retired. I'll give you an example. Here's an exact example that happened in one of our cases. We've got somebody who's got $3.5 million in the bank. He's got a $5 million residence in California, and he's retired, doesn't have any income. Under those rules, he doesn't qualify for as an accredited investor.
Well, he has a net worth over $1 million.
Yeah, but it's not including his house, and that money was like tied up in a.
Yeah.
It's kind of a long story, but under the irregular rules, he did qualify as an accredited investor. So, or if you got somebody say that has a $5 million house and doesn't have $1 million liquid, you know, obviously they can get a $5 million house by not being able to do it. So.
Sure. And so I would say, we're going to do this. We're going to bring Jeff up here in a second, but in general, when we're talking about this, when I'm talking about 1031s, when I'm talking about some of this minutia, some of this has changed, it's a moving target. An accredited investor is an investor that's recognized, right? There is a category that's clearly distinct. There are third-party accreditation services, right, that'll say this is an accredited investor. Anybody in the room an accredited investor? Right? So when we're marketing opportunities, do you get opportunities marketed to you as an accredited investor?
I can't cheat on Jeff.
Don't tell him.
No, but I'm not saying specific, but do you get opportunities that are sent to you because you're an accredited investor? Yeah, right? People are specifically, hey, here's an opportunity. It is available to an accredited investor, right, because of a regulatory framework. And then a non-accredited investor is someone that doesn't meet those requirements.
So does that mean if I'm not accredited, I can't get into a deal?
Depends on the deal.
Okay, what's the difference between the deals?
Well, Jeff, we're about to bring it. Why you're actually, I don't know. Come on up, Jeff. Let me introduce Jeff to answer Jeff's own question. Okay. So Jeff, does that mean I can't get a?
Well, I just feel like we're kind of going.
Participate in the deal.
That does not mean you cannot participate. So that's a double negative. So you actually can participate in certain deals.
Why are you on stage?
So my name is Jeff Young. I moved up from South Florida a couple years ago.
Yes.
And I was in a medical career. I left that thanks to some K-1 income, and I'll tell you all about K-1 income in just a minute. But because of that, I was able to kind of transition out of my previous employment, get rid of my W-2, enjoy the retired lifestyle, and then kind of got sucked back into real estate because I've been investing for so long that it just kind of was a nice transition to get me back into something active. Now, just like
Jeff, tell us what you were doing before you became an investor, because if you don't pay Jeff, it's probably relevant for you to know.
very, very relevant. So for 25 years, I took bones and skin and eyes and saphenous veins and hearts out of people that had died. So essentially, I was cold calling families right after death. So we had relationships with all the hospitals in the area. They would call and inform us of someone passing. We would review the medical chart, review the history on the patient, the decedent, and they would make that phone call. And it was all about, providing a service to the family. So I was calling not to sell them on donation, but to kind of give them the facts very quickly, the benefits that would help them make the decision. And then once I completed the paperwork with them, I'd actually go to the hospital and do the recovery. So I've recovered over 1,000 hearts, probably 2,000 or 3,000 eyes, and that was my 25-year career. But having kids, you realize there's other things besides just working. So being on call, back then we were carrying pagers. being on call and being, tied to whatever was happening that was beyond my control. Once my kids hit, late elementary school, I was like, I cannot continue this. Luckily, I'd been investing long enough to have passive income to kind of help offset, make that flip from working every day to working where I want to, or working when I want to, and that's been just phenomenal. So, yeah, so I was, grew up doing construction with my dad, building fences, seeing him run a business. So I didn't want to be a business owner. I had worked in veterinary clinics thinking that's what I wanted to do with my life. Then I realized all they do is run a business. So I don't want to run a business. I don't want to manage people. And then now I'm doing this. So I feel like I'm managing investments now, helping people get the freedom that I have. And anyone in this room that didn't raise their hand for accredited investors, that's my goal, is to help those people get from non-accredited to accredited. It opens so many doors into new investments, but you can still get into many, many real estate transactions as a passive investor, even if you're not accredited. It's all about relationships, being in these rooms, knowing the right people to get involved with those offerings, and just looking at those deals.
All right, now I get why you're on the stage. It makes more sense. Here, grab a seat on the couch. Mrs. Dalton loves the Drew Barrymore couch.
Hey, Dalton, are we switching over?
Couch.
You're good.
Are we switching over? Okay.
No, use them both.
Oh, use them both?
Yeah, this is for the recording,
Okay,
for the stream, and this is for the audio in the room.
sounds good.
Yep, so
Okay.
we'll just pass this back and forth. Corey and I have got this down. We're like an old married couple, we got ESP. No, so thank you. The reason why we wanted to invite Jeff here is, if you haven't been before, this is the third time we've done syndication, so I recommend you can check out the YouTube channel. We've done a very good job. The first time we did it, we had Sean Thompson come in the room. That's why Sean is participating and sharing and correcting me, right? Because Sean was our expert the first time. And Sean is going to jump in a little later, I think, because we're going to talk about what the role he plays in the syndication ecosystem. But when I met Jeff, I was like, this is really fascinating. Here's somebody that went from being a passive investor, participating, like someone in the crowd here, in these deals, that then was able to, he had this cash machine from his day job, was able to do that long enough to have the income flip, where now I have enough passive income, and now is on the capital raising side, actually over on the fund side, a little past the syndication. So we can kind of go on this entire journey of like, here is what it looks like. Again, like we do here in Grid, here's the life cycle of the investor. Here's the life cycle of a passive investor, right?
Absolutely. Yeah, that's exactly it.
And I think that's really fascinating. So tell me about the first deal like that you got into. I don't know what a K1 is. Assume like I am just an ignorant realtor who sold a lot of houses, never invested in anything, doesn't have a 401k, doesn't have an IRA, just sells more stuff when he needs money.
Well, I was actually transitioning between jobs, still in the medical field, had come back from an overseas employment, moving to South Florida. Well, I stayed with a friend in Dallas, the same gentleman that had given me Robert Kiyosaki's Rich Dad, Poor Dad. So when
every time, y'all, right? Rich Dad, Poor Dad.
Cash Flow Quadrant is number 2 on the list.
Which is the sequel to Rich Dad, Poor Dad. If you never looked to pick it up, we got it on the table there so you can leaf through it. Check it out before you go.
Yeah, Cash Flow Quadrant teaches you why you want to do the wealth machine, not just the cash machine. So I'd highly recommend that book. Regardless, I was kind of transitioning between jobs, moving to a brand new state, knew no one except for my lovely wife. And he's like, hey, you want to invest in this opportunity? I'm like, well, I know nothing about it and I have no money. He's like, well, we can figure something out. So I had a retirement plan that I was able to use in place of money out of my pocket. So I was able to go into my retirement plan and buy the asset in my retirement plan. So that's a self-directed IRA. Was able to establish that, get involved. It was a 506B offering, which we're going to talk a little bit about the difference between B and C. A B offering does allow for non-accredited investors. So it does open up doors for people that you have a relationship with to come in, evaluate the fund or the asset, and make the decision whether they want to join with that group. That said, they can only accept a certain number of non-accredited investors before they have to switch over and only accept accredited investors. Now, one of the things they didn't talk about is why do they want accredited investors? Why do they want to know if you have X amount of money or X amount of funds? Well, I think in my experience, it's been because they don't want predatory people coming after your last $50,000. So having a relationship there, helps prevent that, as well as if you're going to market the deal outside of your sphere, then it needs to be accredited, meaning those people have a set bar of where their income is or where their net worth is, and it's up to them to decide what the risk is to them and their pocketbook. So I love that they have that differentiation to help people that are starting their journey on that wealth machine, and I think it's very important to kind of discuss why there's the differences.
And so we're not going to go into it in detail this time, but we bought that first deal through a self-directed IRA. We've covered that. Again, YouTube channel, Great Investor. I think we did a very good job of kind of breaking down, what that looks like. And if you got more questions, grab us afterwards. That's a great vehicle that is available to a lot of people in this room. If you have a retirement account, you can convert it into a vehicle where you can invest in real estate deals.
Yeah. So again, it was based on the relationship I had with my friend Darwin. He had actually been doing this for years, putting together deals. I kind of seen a little bit of my periphery while I was doing the eyeball stuff. And it just, when I made the transition, he's like, hey, here's what we're doing. Here's our business plan. It's called a private placement memorandum that you will receive from whoever you're talking to about these deals. It goes through essentially their business plan, and then you either buy into the business or you don't. And it's that simple. You can ask questions about it, but typically it's already fixed. The plan is there. You sign on because you want it to join with other people in that group. And I've been in groups that were as little as 10 or 15 people, and I've been in groups that were over 150 investors.
What was that opportunity that you invested in?
It was a multifamily in Dallas, Texas, Saginaw Crossings, and this was in 2013. So I had put in $50,000 for my retirement. Maybe 12 months later, he refinanced $30,000 back out. I still had $20,000 sitting in, liquid retirement. Added it to it. Went into my next deal, Park Row East, and within 3 years, I had probably made $300,000 off of that $70,000 I started with. Now remember, this is all in my retirement, so I'm starting to see these multiples and this flow going into my retirement, which means I was not taxed on it, didn't have extra regulations I had to jump through or filings I had to do, so it was just going right back into my retirement, and it was just a phenomenal opportunity to see that increase. Go ahead, Sean.
For that $300,000, how many tenant phone calls did you take to make that?
Let me think. 0. So I did 0. I didn't have to sign on a loan, which is probably the biggest thing. A lot of people, like you go to try to buy a house, they want a full exam of everything you do. And to be able to sign that loan, your qualifications have to be X amount. Well, being able to get leverage, which hopefully in this room people are starting to understand what leverage is. That's using other people's money into a deal like this. So the other people in this case was not just your friends, but it was the bank. So having the right bank loan to go against that helps with the appreciation, and you have the leverage going forward. But being able to have someone sign off on that loan gave me the ability to have leverage on my retirement plan, which was, you just can't do that.
How much time did you spend at that property to make that $300,000?
I did not even step foot on any of these properties. So the first 7 or 8 years I was in multiple properties. I never once saw them. I've got a property in Hawaii I've never been to, unfortunately. So there's no need to manage it. You have to find the sponsor or the operator that you trust, and you get reports and you kind of just file them away. But it's been I love that journey of not having to have one more thing on top of me with the pager going off or the phone calls or the running to the hospitals in the middle of the night or the medical examiner's office. It was set it and forget it, and it was all going back into my retirement plan.
In that, so you participated in those as a limited partner, right? Like an LP in this regard, right? And so you would have had a general partner, or sometimes there was like a sponsor that was the one who's running that. And I'm curious, if I'm looking at participating in something like this, it's my first one, like what should I look for in a general partner? Like what should I look for who's a general partner, who's a sponsor and something?
At this point, history. Like you've got to see who's made it long enough to have been through downtimes, because there's a lot of people that did really well from 2013 to 2020, 21, 22, and then all of a sudden cash calls and now we're seeing foreclosures. So looked at a foreclosure today. You got to get the right connection with the bank, and you can just There's blood in the water. Now that's in Dallas. That's a different beast than what we're seeing here in Knoxville. So we'll get to Knoxville in a minute, but I am very excited about the multifamily opportunities here.
So you said history because I don't know if y'all know this because I think sometimes the reporting is a little convoluted depending on the agenda of whoever's reporting. But we have been in the longest economic expansion in U.S. history, and it's not close. It's like Michael and Kobe versus whoever. It's not close in terms of how long the economy has been good. But to your point, meaning that I like that you went all the way back to 2012. Hey, how have you navigated a downturn in a market? Because if you never navigated a downturn in a market, you might not have the relevant experience for the market we're going into in Dallas.
Yeah. So to speak to that, so he had been in the market since 2004. So he had actually been through some in 2007, 2008. He'd actually had one property that that underperformed, meaning investors actually lost money. But you want to hear those stories. Like, you learn from your losses more than you learn from your wins. So hearing him and how he was able to hit it head on, communicate with investors, and really set the expectation of this is what we're going to do, and this is how we're going to salvage this project. So walking through one of those is probably more important than hearing about his whole wall of success stories.
When something underperformed, what was that one where he was like, what did he do to make that right?
So that particular one, it was 2 apartment complexes on either side of the asset had gone into foreclosure. They were purchased by a local church and they were turned into free housing. It's really hard to compete on a lease with free housing next door. So he was able to at least maintain a minimum amount of rent to show a little bit of income to cover the great debt that he had at the time, and was able to sell it with a loss of, I think, probably 60% of the capital. Which, I mean, again, he could have easily turned in the keys, walked away from it, and just left it, with the investors like, well, you lost your money, sorry. So you really have to see how they dig themselves out of those holes, or at least how they stop the bleeding. So.
Yeah, and I think that's something important to talk about. Like I do try to emphasize when we talk about that don't sue us is investing is not, it seems like, oh no, like how large of a pile of money am I going to get? Because does anyone know that Knoxville is the #1 market in the country for appreciation in the last 6 years? 60%. 60% since 2019. So again, a lot of people here have made money. Many of them are not smart. It's pretty impossible to not make money, right, if you own property before 2019. Like, you really, right? Even us, Cory, we've done, right? We did this with Hannah. We share this. Yeah. Like, we went double the budget and still managed to be fine now because the market bailed us out. Like in another market, that would have been a disaster. You'd still be trying to get.
Still trying to recover.
Yeah, from that one investment. So I think it's just something to keep in mind of like understanding the landscape of what's happening. Okay, so that's how you found that first deal.
Yeah.
Personal relationship, great. You're in a networking community, so you've known that guy, you've watched that guy, other people know that guy.
Yeah.
He came to you and was like, hey, I think this is a great opportunity. You
So
trusted him.
I would say beyond just trusting who you're going to sponsor with or LP with, talk to other investors that have been with him. So don't just take his word for it. Like you said, that's not, they're going to give you the rosiest picture. But if you talk to other investors, they will give you the background. So most of the people that come into these investments, especially the 506Bs, have some sort of relationship with the sponsor, the operator, one of the KPs, someone that's lived on one of the properties. Like, there's so many ways to be connected into that group that you need to find people in each one of those areas and ask them, okay, well, you're living here in one of these communities that this guy services. Are you happy living here? Like, it can't be just about the money. This is one of the things I took away from a meeting I went to in Chattanooga. If the only reason why you're partnering with somebody is because of the money, it's not the right partnership.
Tell me more about that.
So if you really just want to get money out and money in, then I would say syndications are not where you want to live, because it is a relationship. It's not just, hey, let's do this one thing and be done. You really want to create that momentum. That's how you grow wealth. So just like anyone that's flipped a house before, you're already looking for the next one before you finish the first one. So when he has a cash out refinance, I'm already like, hey, I already know that I want to be in the next deal.
I'm curious, how many people that lost money with him invested with them in a subsequent project?
I have no idea. That's a good question.
I'd be curious to
I
see.
do
'Cause
know
based
that-
off the return you got,
Yeah.
I mean, he could have made it whole just by come invest with me in another opportunity.
Yeah.
Interesting.
So that's another thing I would speak to someone that's a new in investing is if you have $500,000, don't put it all in one deal. Like try to source that out into different deals, look at what the timeline plans they have. With that refinance, I knew that I'd have a liquidity event. I knew that there'd be some velocity to put that money into the next deal. So having the money back to be able to roll into the next one, don't go out and buy you a new car, but into the next deal, and then let the cash flow start paying for that car.
So I heard a couple concepts that you just laid out there kind of quickly, right? We talked about diversification. So pretty, diversification is a pretty classic investment strategy. If you're brand new, you can research that of just like, I want to have my assets spread across multiple, my investments sometimes spread across multiple investments, multiple time horizons. It's a way to hedge risk and have a diversified portfolio. And some people will argue for and against that, right? You also talked about a liquidity event. What's a liquidity event, Jeff?
So a liquidity event looks like any sort of refinance or anytime they get a big capital return. It's not necessarily return on investment, but it might be return of your investment. So it's typically not a taxable issue. So if I'm using money out of my pocket, I will not have to pay tax on that first X amount of dollars that come back to me. So that's a very nice thing to have happen. So you're able to redeploy that money into the next deal while you still have the same amount of equity in the previous deal. So it's not like he's buying you out of the deal. You're still in that deal. You're still participating in the cash flow and the equity build. But instead of the equity sitting in that property, you're able to take that equity out and go to the next property. So knowing that you have someone that you're partnered with that's going to pay attention to, what's the debt on each one of our assets? What's the time horizon on getting the capital improvements done, getting the rent increases done that we want to do to hit the metrics to get that refinance done. So that's one sort of kind of capital event or cash out equity event. The other thing would be like, obviously, when you have a sell. So that's when you're starting to realize those capital gains. A lot of people that are doing flips, they have capital gains that they're dealing with. So you may do a flip and get, 30% back on your money, but then if you're doing it yourself under an LLC, you have self-employment tax, you have short-term capital gains, and you have to, do every bit of the work yourself.
So a lot of things that we're covering here kind of on a high level. So if you're new, one of the things we talked about is having this conversation with someone in the back of the room is what's your strategy, what's your horizon, what's your philosophy around risk, right? What's the structure in which you want to hold into it? We didn't get into the tax side of the game, right? And so one of the things that is really interesting about real estate is Jeff just described two different kinds of liquidity events, which are how do I generate liquidity? I can generate one through debt. That is never a taxable event. If I go out and refinance, or you'll notice why the rich all get paid, CEOs get paid in stock options, right? I'm borrowing against my stock options, which is a tax-free event because I'm creating debt. So that liquidity event is a debt-free event. If I have a sale, right, then there is going to be a taxable event, and then I'm going to have to employ different strategies of what am I doing to mitigate those taxes. If you want to know more about that, definitely come to the STR playbook, have a conversation with Charles Shapiro. We can dive into some of those things. Right?
Yeah, bonus depreciation is a wonderful thing.
Yes.
To have that back into our handbook, our playbook, is phenomenal. If you exit and you were able to place that capital in another deal in the same year, you also have those advantages of rolling that same capital gain, kind of hiding it behind the new depreciation on your new asset. So that's been a very nice thing. I mean, even 2 years ago when they were still when they were phasing it out, I've had investments that because the bank is here and the investors are here, all that depreciation flows up. So you're taking depreciation on the full $10 million asset, but the bank may have $7 million of it. They're not participating in that depreciation. So the depreciation you can get off some of these investments can be dollar for dollar year one.
So anybody have questions on this before? I don't want to move on, but there's a whole, so leverage, one of the reasons leverage works, right, is because the U.S. is one of the only countries in the world where I can go put 5% down on an asset, right, over a 30-year time horizon, and I can go purchase the asset. And then I get to take advantage of, well, I only put 5,000 down, but that property was worth 100,000. So then when it appreciates, right, all I owe is that 95K, right? They're not participating in that appreciation. Same thing, I can go take depreciation on an asset, right, which is just the depreciation you probably used it for on your vehicle or something else on your taxes. You can do it on your property. It's spread out over a time horizon. We can get kind of niche on ways to avoid this, or, bonus depreciation is that I can go take depreciation that's up to 100% of the purchase price.
Absolutely correct,
Yep.
especially in one of these partnerships.
So when I'm using leverage, I can go create more offset. Then it can be a huge way to offset income. Again, these are the tools that the very wealthy, the largest corporations, the largest companies are using. Are tools
High net
like
worth
this.
earners are definitely doing that.
Yeah.
They're looking more at what's my depreciation dollars than what is my appreciation dollars.
Yep. And I think we can go deep on this in another one. I know we might be starting to lose folks because some of this is nuanced.
But neither one of us are tax professionals.
No.
So
we're not.
again.
But just in general, if you want a great book on this, Tax-Free Wealth by Robert Kiyosaki's accountant, Tom Wheelwright. If you like Rich Dad Poor Dad and Cash Flow Quadrant, Tax-Free Wealth is I think the best primer that I've seen that explains it at that same level where I'm able to understand it, you're able to understand it conceptually. And all I need to do is understand it conceptually well enough to hire a professional to help me run the play. Is what I don't need to become.
You'll know what questions to ask.
It's like if you're an attorney representing himself, you have a client. You're for a fool, yeah.
Yeah.
A fool for a client. Like there's some of this stuff. Like if you are not getting some help, you're gonna run afoul. Yeah, Nate.
So I don't know if you're gonna cover this,
Mhm.
but the cool thing about what Jeff is referring to is syndications, fantastic investment vehicles. But I guarantee you, the ones that he's investing in, there's an investor pitch deck. And it's usually pretty extensive. And in that pitch deck, it lays it out for you. And I'm only bringing this up because it's a great way to learn it. Like you could get a hold of these pitch decks, whether you email them or they're online, and then you start understanding the lingo, and you start understanding the exit strategies, and you start understanding what the operating agreements look like, right? So maybe you don't do the first one, maybe you don't do the second one, but now you're in the number 5, and you're like, hey, this one lines up. Because those investor presentations are gonna use projections. And if the projections, if you can do the math, and those projections line up, that's a good investment. When they don't line up is when you say, no thank you.
Yeah, the biggest one is looking at the exit plan
Yeah.
and understanding cap rates. So if you don't, it sounds like it's a very complex sort of thing, and it's this.
Here's what I think we'll do.
Yeah.
We've set the stage. We talked through one of those deals. Let's go back with Cory here. Let's go back to the slides that we were butchering. Start at the front here. No, because I want you to walk
Yeah.
through them, and then let's walk through some of the basics of syndication. Cory can turn that so you can see. Or you can turn up there, whatever's easiest for you. It goes before that, Cory. There's 2 more. We were just starting to talk about accredited versus non-accredited, and I'll let Sean and Jeff get into the nuances of that. Right?
Accredited investors.
Yep. So and there's one more here before that. Because we were talking before this.
Placements.
Yep. Okay. Next one here. So there we go. Boom. Placements. Any thoughts? Any ideas here, Jeff? Or so we're basically what we're talking about is SEC regulations, and I guess I don't know how deep you want to get into me trying to explain my limited understanding of SEC regulations and series licenses and how much.
I
we need
think
to set the
yours is
stage.
about the same level as mine.
Sure.
So any syndicator or any operator is going to have a team, and that team is always going to have an attorney as one of the key components. If you are talking to someone and they can't tell you who their legal counsel is, walk away from the deal. So they do have to register. It's not registering as a security, but they have to register the offering. They have to file whether it's a 506B or 506C. So it determines what type of forward-facing marketing you can do for that offering. Again, if you're going after somebody just based on the deal, it's a 506C. It's required to have accredited investors only because you're literally saying, hey, we're going to get you 24% on your money. Can't do that if it's 506B. You're really just selling yourself. You're selling your company. You're not selling the deal. So you're bringing people in, making sure they have the opportunity to learn the education or receive the education to make that decision. Just like when I would call somebody about donation. Like you're really just making that connection, making sure they understand the process and answering questions for them, and then then you can ask them if they want to hear about a deal.
Awesome. So the next one talked about, which you talked about before, that private placement memorandum, I believe. I can't.
Yeah, private placement memorandum
Yes.
is very similar to what he's talking about with the pitch deck.
Yep.
So in that, it's all the attorney jargon. So, but at the very end is typically the business plan. So the last 2 pages of the entire 120-page PPM are pretty much where you need to focus. You're looking at what their predictions are, what are they hoping to happen, and then really you need to ask them, why do you think this is going to happen? You know, what just blew my mind was how much a cap rate change can affect that last number. So really diving into it, you need.
What is cap rate? It gets thrown around a lot. People, I think, ask it a lot. What is cap rate?
Sean, you want to handle that one?
Yeah, I'll cover it.
All right.
I'll say it with Sean.
Perfect. Thanks, Sean.
You kind of hard to tell us apart though.
So basically, cap rate stands for capitalization rate. And basically, when you invest in something in a certain area of a certain type of investment, it's the money that you expect to get on a return. So your cap rate is your expected level of return in that area for a certain asset. So retail has a higher risk than a multifamily, because everybody needs a place to live, right? But you may have, drive around, you look at all the different malls and retail areas, and they're not always full. So retail carries a higher risk. So retail will carry a higher capitalization rate than multifamily. And then the year and the condition of the property also play into that. So if you have a new property, it will be a lower capitalization rate, because you would think it would be easier to get tenants in a newer property and it would be easier to manage. There's not as many things that can go wrong with it, and you expect a different clientele than you would a 1980s property down the street that has a lot of things that might go wrong with it, and it's harder to get tenants into it. So capitalization rate, it's not as complicated as you think. Once you get into it a little bit, it starts to make a lot of sense. It's kind of hard to explain up front, but the more you work with it, the more you can kind of drive down the street and go, okay, the cap rate on something like that's going to be this, cap rate on something like that's going to be this, and it varies by area too. So like Miami has what we call compressed capitalization rates. It's a very high capitalized market, and capitalization rates in Miami are going to be a lot lower than they would be like in a Knoxville. You would expect to come to Knoxville and make more in a Knoxville than you would in a Miami.
Perfect.
Thank you.
That's the long answer. So for a newbie like as coming on board, it's what someone's going to pay for that cash flow. So if you're making $100,000, how much is the next guy going to pay to make the same $100,000? That's the simplest explanation of what a cap rate is, because really it's the person that's going to buy your asset. Like I said, I never even had to step on these properties, but I knew, like, okay, well, we're going to be earning $5 million a year off this property, and this is how much we're paying for that cash flow. Now, to Sean's point, having expenses on newer places that have better cost insurance, they may have lower maintenance upkeep, they may have better water savings opportunities. So there's a lot of things that help stabilize the project so you don't have as much risk. So you want, how much is someone going to pay for that property, but then how much risk are they willing to put in to get that same money?
Sure. And then there's a lot we can cover here, and we've covered some of this before. So if you haven't come before, we've gone through a couple. I think Sean's story was great. Tillman's story is a great story about how to go actually acquire these and underwrite these, and broke down like the mechanics of being the syndicate or hunting. What might be helpful right now, and then I'm gonna let Cory run through the mechanics of a deal, would just be, how did you get to, just story time, you did the K1s. So what's a K1 about? So you started getting these returns. You started just getting like retirement money coming into your retirement account. You started getting more returns. You're investing. How many deals did you end up like investing in?
So there's 3 different ways that I know to make money: W-2,
Yep.
1099, and K1s. So K1s are unique in that you have no active participation in that asset. So a K1 is really just a passive income statement that I receive every year. So over the years, I've probably been in 12 different deals. I'm currently in 9 different deals with 4 different sponsors or operators. So I've got different assets with different people, and looking at what the cash flow is on each deal. So those PPMs, not only am I looking what their exit strategies are, but what what is it paying over time, and when do we have liquidity events, or when do we have distributions based on either earnings or rentals.
And so you did that. How many years ago did you retire? I just want to set the stage for the next stage you go to.
2022 is when I moved up from Florida. I left my iBanking job and was able to come up here. My wife's a school teacher. Kind of ironic talking about school teachers. She was very thankful last year when she had to sit through their orientation about how to plan for retirement, and teachers could not put 3% of their income aside for retirement.
So they could not put 3%?
No, teachers didn't even have the capacity.
Oh, yeah.
They needed every single dollar. So to get to a point where your retirement is funding itself like mine is, and you have cash flow on the side to sustain your living, it's just a wealth machine.
Mm-hmm. If you really want to get radicalized, if you do the math, it would take you 80 years at the median income in the U.S. to save enough money to be able to live off the interest. Like, you know, that golden rule, you have this much in assets, 4%, 80 years. We do some education for young people, and like everyone, it's literally impossible to retire in the United States if you don't invest. Tell everyone you know. They don't know. Yeah, I think that's fantastic. So, just because transitioning, so Cory's got some questions on how to structure some deals. So you went through, you got to experience this on this other side. What are you doing right now? Before I just want to give some kind of credibility or paint a picture before we jump in here. What are you doing now? You're working for a fund,
So, like, I was done. I was like,
Yeah.
okay, my wife wasn't working, I wasn't working. We were up here raising kids, loving life here in Knoxville, getting really into the Vols. And she's like, I'm bored. So she went back to teaching, and she's like, Jeff, you need to get off the couch. So my very first thing was, okay, well, I'm going to go do some outreach with my church. I'm going to try to do, be involved. And then the hurricanes hit. I went and did some hurricane outreach and was able to give them my time. And it was great to kind of be back in that world. I was talking to a gentleman that used to work for Caterpillar. I told him I've got, a property that I just want to put a couple houses on. He's like, go talk to these guys. So talked to some guys here locally that are development partners. And if you don't know what a development partner is, they kind of help you walk through the entire process, taking it from bare land to, built houses ready to go. So, very Christian-based organization. Our personalities just meshed. Had a lot of trust with them from day one. And they asked me, well, Jeff, what are you doing? I'm like, not a whole lot. I live off my K1 income. And so I told them about how I'd been an LP investor for probably 12 years, about 10 years at the time. And he said, well, would you like to join our team and help us raise capital? I'm like, well, I see great opportunity here in this area. That's why I wanted to build the houses. They presented me the option of helping with raising either money for multifamily or single family development. So I've decided to help them raise the funds needed to get some of these opportunities out of the ground and bring them to investors again to get investors involved in these deals they don't have access to. So I really don't want to just go after accredited investors. I really want to open up deal flow to people that want to have their retirements funded by real estate, or they want to have their life funded by real estate. And that's how you can do it. So I started with them maybe a year ago, actually a little bit less than that. And I see the deals, I've worked with the underwriters. So again, back to the group of the syndication. So you got your attorney, you've got your sponsor, but you have to have someone that can do the numbers. So you guys underwrite deals all the time. We're talking about deals that are anywhere from 10 million to 100 million, and those numbers have to be right. So there's a lot of extra numbers that you have to look at and you have to know. So having the right underwriter, looking at the deals, we're able to find and identify a property that they wanted some help that was in their pipeline. They already own the land, so we're bringing that deal to the public right now.
Okay, that's cool.
Yeah.
So
while they're building my 3 houses. And as a matter of fact, you were asking at wins. I went under contract for a 6-acre property on Friday that I'm going to build 24 houses on.
I want to take a minute because we walked through life on the LP side of things and what that's like, and some of the different things that can go wrong, can go right, can go wrong. What I'm curious, certainly for me in this, right, is now I want to talk a little bit and switch things onto what life is like on the general partner side of things, or the person who's structured, right?
Seeing, is it the sausage made? Is
Yeah,
that what they call it?
Yeah, absolutely, right? So like, hey, what's the best way to structure my first deal? I'm really good at finding opportunities and doing some general initial underwriting on it to get it like in front of somebody. But I want to talk through here.
Corey needs 225K.
Yeah, by the way, I need like 225
Mine's got
grand
some cash thrown
for
around.
a deal right now.
Yeah.
I got
Got
a
a
5
sick
unit. That's
deal.
pretty sweet. So I want to talk through, at least initially, let's talk probably two different kind of ways to do this, right? We have a straight split and then like waterfall. So let's just kind of walk through maybe initially a straight split, and then we'll kind of phase into that. And I've got some follow-up questions. So.
No, these are great questions to
Yeah.
ask of a sponsor.
Yeah,
and
so-
an operator. So how do you want to structure your deal to bring people in?
Correct.
And then what kind of deals as an investor do I want to be involved in?
Right.
Now, whenever I started in 2013, every deal I did was just an 80-20 split. So 80% went to the investors, 20% went to the sponsorship team, and that was divided amongst themselves. And the assets overproduced, just like you were saying, everything was winning. Cap rate compressions, meaning people were paying more for that same amount of income, drove the values through the roof. Luckily, I was with a sponsor on probably 1,000 units. We sold. He owned 2,000 units. I was a partner on about 1,000 of those. Half that portfolio sold in 2022. Just happened to coincide with my retirement. So that exit was at a time when cap rates, people were paying the absolute most for that cash flow. So for $100,000, they may pay 4x that just to get that property under contract. So a significant time to exit. But moving forward, a lot of what we would consider retail investors, which would be someone between 50 and 200,000, the retail investors, a lot of them have gotten burned. And people that invested in 2022, if they didn't have the right sponsor, they have lost 100% of their money today. And that is true of every location. It's not location specific. People were overpaying, so the values have dropped. So they were paying high then, and now the values can barely, the income is barely covering the rents. So there's a huge adjustment in the market right now. So as you're looking for forward progress on these sort of deals, you want to look and make sure that not only does the sponsor have skin into the game, meaning they have their money into it, but you also want to make sure you get paid first. So speaking to the split, I would say moving forward, I would only want to participate in deals that had a pref, so meaning they get paid first, X amount % per year before the sponsor and their team get paid. So that's where we're at today. I feel like that's kind of transitioned. I don't like the word waterfall, and it's kind of got a very negative connotation. But I mean, that's exactly what you have here in this picture.
That's right.
So a waterfall.
So that's the next one. That's phase 2 of this. We talked to straight split, which would be just what it sounds. It's shared piece on it. Your general partner sponsors retaining 20% of that, often is offering up 80, and obviously that can change, but it sounds like 80-20 is maybe an optimal number or a preferred number to aim for on that, and then we can shift into a waterfall as a separate structure, which is going to have some tiers to it as it goes, right?
So go ahead.
Yes, you're talking about, so right now, we're looking at foreclosures that happened because of 22 and 23 too, probably, right?
Yes, sir. I mean, that's on deals that were underwritten with inappropriate exit strategies. So their exit strategy were like, hey, we're going to buy it with this equity based on this type of income and people paying this much for that income. Well, they may have grown their income, but what people are paying for that amount of additional income has gone so much down because of interest rates. So the debt that they can go out and get is kind of cut off that sort of buyer.
Well, no matter what caused it, the equities have gone down a bunch in the last 3 years. You agree with me on
That's
that?
totally correct. And a lot of it's because with multifamily and with a lot of larger assets, you don't get,
Even single family.
yeah, you don't get 30-year and 40-year amortization. You do a 5-year interest only and maybe another 5 years amortizing. So you have a short lifespan there, but then you also have what's called bridge loans, And if you've ever dealt with a bridge loan, you know that there are times where it's like you just can't afford to refinance, and you're gonna lose that asset.
How much longer do you think these foreclosures will last? And if the foreclosures are still happening with what's going on right now, would you not agree?
I would say in the multifamily space, it's going to be very location specific. I don't see that happening here.
Knoxville. I'm talking about Knox County.
So when we're talking about multifamily here in this area, what's very nice about multifamily here is that the people that own it have owned it a long time. Some of the stuff I've looked at, they don't even have it on like the equivalent of Zillow. It's called CoStar. They don't even have that on there because there has never been debt on it, or the debt's been paid off for so long, you can't even research what was paid for it. So some of these people may have $8,000 a door into some of these 300 unit places. But because they didn't flip it in 2022 when the prices were super high, they're not in trouble. So they have plenty of cash flow. They're never going to let go of it. It's a legacy asset that'll get passed generation after generation within that group, which is phenomenal. What I've seen in big cities, Dallas, Nashville, Austin, Miami, those places, when the cap rates dropped, a lot of people sold, or even before that, people were flipping these assets. So imagine you go out and buy a house, you fix it up, 6 months later it's worth this much. The next guy is going to be like, okay, well, I can make it even a little nicer and make some more money off of it. Well, now you can't. And that's the same thing with multifamily, but not because the asset looks bad, but because the cash flow versus the debt is bad.
I'm just talking about the 3 year span, say 22 to 25.
What I would say with Duke is, let's come back to this closer to the end, because I want to walk through the structure.
Okay.
Because some of this stuff, if you don't have a macroeconomic understanding of what's happening, you're just lost. You're just kind of lost about some of this, and I think we can tag it at the end. We can have a broader conversation. Yes.
Real quick, when interest rates shift, that's when the bleeding stops in real estate.
So, but I just think, because even now I'm like, in my head, I'm thinking of, if we want to talk about why was that, well, if you go look at savings rates and like the amount of capital that was there, PPP, there's a lot of things we could talk macro that were like, if you're paying attention to, it was obvious why cap compression was happening. There was lots of money in the market looking for a home. There wasn't any, and they had super low interest rates.
But what I really wanted to get to was that Knoxville is an anomaly. Knoxville has not been, the multifamily market has not been flipped.
Well,
so we're not have these.
And Knoxville was an anomaly in 2007.
Yeah,
That's right.
You know, like because people did not do the same thing. They didn't go cash in. They didn't buy it. They were like, nonsense. Oh, my house appreciated 10%. No, it didn't. I'm not doing that. I wouldn't pay that for it.
Yeah, so the multifamily is the same way here. So trying to go out and buy a multifamily asset is very difficult in this area right now.
Yep.
There's another big reason for that too. Our terrain doesn't allow for a lot of new multifamily, so you can't do like big 300 unit apartment complexes here because you can't.
Yeah,
Our
it's
terrain
not
doesn't
like
allow
Florida where you could just keep building forever, or
They
Vegas.
build on all the flat places, right?
Yeah, or Phoenix, right? Why does everything come out of Phoenix? Because it's all flat and they can just keep sprawling, and that's why it's this kind of canary for everything that happens in the real estate industry nationally.
Yep.
Yeah, but if it's okay, we can come back and have a broader macro conversation, but I just don't want to lose. If I'm here and I'm brand new, I'm like, I don't even, what do we talk? I don't even know what cap rates were.
But it's great to know that Knoxville is not having the issues that other places are having.
Yeah, so
that's
cool.
a key point.
So getting back here just to like a waterfall structure, we just throw out like a word pref, and you hear that like a lot in this space. But really, what that is, that's a preferred return, right? So just keep that. So if syndication is offering out like an 8 pref, it's an 8% preferred return, and that means the first 8% of those returns are cash flow or profits from deal go directly back to those investors that participated in the deal, right? That is, the investors get 100% of the first 8%, and then the general partner may get a small piece of that. Where a waterfall kicks in is where returns start to get above that. So if we get beyond the 8%, let's say this was offered out at an 80-20 or a 70-30 split, for example, any returns maybe between 8 and 14% might shift now. We might go from 80-20 to a 70-30, and your general partner your sponsor starts taking a little bit more on that. So 70% goes back to your LP investors, and 30% to the general partner, and that can extend from there. So maybe we get beyond a 14%, and that can now shift to a 50-50. So what that does is that incentivizes the sponsor, the general partner, to actually ensure that this performs, because the better it does, the higher reward that they can have at the end.
Yeah, I think a lot of people look at that and say, oh, they're taking money out of my pocket. But essentially, they're making more money so that everyone can have their pockets filled. That helps them, when they do that, it helps them bring more money into their team, more money into their marketing, more money to go out and source deals. They have to have capital to go out and put the deals under contract. They have to do all the due diligence. They're paying, they've got their attorneys they're paying. So they have a lot of overhead. So they need to hit some of these higher marks just to stay in business and get those bigger deals going.
Yeah, but I've often found what I can appreciate that is it creates alignment in terms of incentives. And the better. So if I'm the sponsor, I'm the general partner, like bringing this together. The better I can get this to perform, the better upside I have in the long term. But you're still guaranteeing, or at least promising, like kind of aiming for that return, that preferred return, to your limited partners on the front end. Just creates some alignment on the backside. Yeah.
Well, and I think the way it creates alignment is the limited partner and the general partner have different incentives. So what it creates alignment is I am a limited partner, I'm more risk averse, I want something predictable, awesome, cool. If it cash flows at 8%, this, fantastic.
Oh, yeah.
And then if the exit event makes sense, cool, I'm gonna get my 8% every year, and when it exits, I'm gonna get this return on my money, high five, yeah, that's way better than my freaking IRA right now, I'll do that, right? The general partner, risk taker, right? I wanna hire, great, if I can go do this and crush this exit, now I set myself up for the next one. So I think when we talk about creating alignment, that's what it's creating alignment is. With the preferred return, the waterfall can make sense because it can serve two different needs for two different people. If that makes sense.
Exactly, yeah.
Yeah. I have a question I wanted to get to, like as somebody who's going down this journey like myself, right? Starting to find some larger assets, some larger opportunities. We talked earlier about, dream team, and if I'm the limited partner, like looking at somebody like that, you'd want to identify like who that is. I mean, who is my dream team in this? So I know I need an attorney in this. Who else do I need in this dream team of mine?
So you will need someone that can sign on the debt. That's usually called a key principal.
Yeah.
So they have to not only have the net worth to be able to take down that debt, they have to have enough liquidity that the bank's going to require. That money doesn't have to come into the deal, but they have to show that they have the funds liquid at the time of closing to get the deal across the finish line. So that's a key. That's a very important person to have on your team. You have to have the underwriter, which is the deal source. It often comes down directly to the syndicator. I would say you also have to have investor relations, because once you get to the point where you have 600 investors across multiple deals, you're going to be getting calls every single day. So even with all the reporting, anything that you can share with them online, there's still going to be calls. There's going to be, we've gone through a divorce. We need to split the asset. We moved it from one bank account to another bank account. So you will need to have customer service. So kind of like having renters.
Yep.
So you have these renters that are your LPs that you need to take care of. So that's another key component. Asset managers are very important. That can be either the operator, it can be the sponsor, or you can have someone completely separate. The asset managers.
Asset manager, the asset in this case is the multifamily property. So like a property manager, asset manager, similar, different?
Similar and different. The property manager is taking care of the day-to-day operations. They're looking at the leases. They're looking at, has a poop been picked up? Is there any repairs needed? The asset manager is more like, okay, well, it looks like those tiles need to be replaced on the roof. Let's get a bid for that. Or at an even higher level, how much equity is sitting in this property? Gotcha. So the asset manager is truly managing the financial basis of the property. Okay, we have a tax appraisal come in, $2 million over what we were expecting. That's going to really hit us down the road. Do we have enough set aside in reserves for those events?
So my asset manager is providing strategic guidance, not just like day-to-day operational.
Absolutely.
Gotcha.
Yeah.
Okay.
And I would say those are your key partners. You obviously have to have a really good lending partner. So having not the capital part, but the debt service. So having those relationships with either local banks or a broker that can get you into institutional lending, Fannie Mae, Freddie Mac.
And one of the things I was talking with Sean about before this is that, he said he's been looking at deals because some requirements have changed, where it used to be you could get, one of the interesting things about being a syndicator was hey, I found this opportunity. I can go talk to a bunch of LPs. I can find a guy who can sign, who's a KP, who's just got the net worth, and that works. And now that KP needs to be someone with experience in the space, not just, you know, your buddy, you know, who sold this opportunity sitting on a bunch of capital. The KP's got to be someone who's experienced. So he's like, oh, I've changed because, you know, it's harder to find a KP with experience. Experienced KPs are more in demand.
Yeah, it's
Yep.
just like LP investors. You want them to be on the journey with you. So as you grow, their net worth grows, and they're participating in these deals.
Yep. Yeah, that's fantastic. I see that. Yeah. What have we not covered that we should be talking about here, John?
I think really, can anyone be a syndicator? I believe they can. I think everyone came here to figure out how can we do this on our own. You can do this on your own. I would advise against it because you need a team. You really need a team. But if you have, focus on your expertise. So my expertise was, information, sharing information with the donor families. Now I'm sharing information with potential investors. Not every investment's right for every person I talk with. So if they tell me that they really want on a deal, there may be deals I talk them out of because you might be 65 and there's not a liquidity event for another 10 years. So there's different things that you want to make sure those partnerships, again, it's not just about the money, it's about having common goals and working together in a partnership. What was the question?
Is there anything that we haven't covered that we should have covered?
So that was a good one. Let's see. Exit strategies are important. We've talked about that a little bit. We've talked about how Knoxville is different. I think as a syndicate, if you want to do a syndication, I would say the best place to begin is identify the asset class you really want. Like you can do a build to rent community with 25 houses. You can do a multifamily with 20 houses. But a lot of the same infrastructure is going to be needed whether you do a 5-unit multifamily or a 500-unit multifamily. So you've got the same key people that you need or the same tasks that need to be completed. So if you have an expertise in underwriting, that's where you need to plug in. Then you bring someone in that's got the legal expertise. Then you bring in someone that knows how to talk to investors and tell them how this deal can work for them. So that's what I am now. I'm kind of one of those people on the team to get these across the finish line. I do have a deal that I will be the sponsor on that I'm bringing people into, but it's because I partnered with the right operator. And in this case, it's a development deal. So having the right operator that has a history of performance that I can trust, and I can look at the deal with them. I put money in, they put money in, and we come to a partnership moving that forward.
So I want to be respectful of time, but there's a couple of things I want to just hit on. I think that would be helpful. Go watch Tillman Dunbar's appearance here last year on How to Syndicate. I highly recommend if you want to go that path. Tillman underwrote 50 deals. Tillman had to create an alias, Don Dunbar, because no one was responding to Tillman. It's a great story.
That's cool.
Like he did this, he came right out of the military into real estate and started as a syndicator and went after it. But he went after that as a full-time operation. Got good at underwriting this, and he had a mentor to help on the syndication operation side. One of the things that we kind of glossed over that I think maybe we've set the stage enough to talk about is why are these deals so attractive? The deals are really attractive, like from the LP side, because of leverage and because of tax benefits, amongst some other things, right? So
also you can use retirement funds, which is money that you can't use otherwise, that you're able to way outperform the market. Even with a great market, we're still outperforming on those.
So I can come in and I can participate. You mentioned this where I might be able to put my $50K into this asset. We can take depreciation against it, so we can create some tax advantages that I can participate in, that I can use on my personal tax return to offset income. That can be really attractive. So even it can even boost kind of the returns on that. Also, one of the things we haven't talked about here is what's attractive about this. If I'm investing in a commercial asset, which every one of these multifamilies is a commercial asset, the concept of forced depreciation.
Yes, absolutely.
Right?
So,
I don't know if you want to take that or I can take it. You want to explain what forced depreciation is?
You can do the appreciation. I'll follow up.
So what forced depreciation is the residential market is based off of comparable sales, right? If your neighbors all sell because, you got a terrible neighbor and they all fire sell, like, the property value will go down in your market. If there are distressed and motivated sellers, it will affect the property value in there. On the commercial side, if you look at commercial appraisals, whether they are short-term rentals or commercial assets, those are based off of income. So if I come into an asset, Sean, go see Sean's story. It's a great story of talking about the value of forced appreciation. If I come into an apartment or a multifamily and I improve the rents, I immediately improve the value of the property. The value of the property is tied to the income of the property. So if I improve the income of the property, I'm not reliant upon, right, what the neighbors are doing necessarily. If I can improve the value of the property, I can force appreciation, which is why I can come to you and say, here's my plan, here's what we're gonna do, we're gonna add these assets, we're gonna improve this. This is why I have a predictable exit strategy, because I know that if I can get the rents to here and lease this out like I've done before, then we'll force appreciation, which will allow us to refinance or create a liquidity event or something like that.
It's also where inflation comes in handy on some of these assets, because your debt's going to stay the same across the life of that project. Hopefully you don't have a floating loan that's going up.
Sure.
So there are operators that had issues with that. But if you have the right debt, you're paying
So you
with
borrowed,
tomorrow's
you borrowed
money.
yesterday's rate, and you're
Yeah.
paying with tomorrow's inflated money.
Absolutely. Yep.
Sure.
With that appreciation, you've got your rent growth, and now it's easier to pay those dollars back.
Yeah. Anybody? We're gonna wrap up here. We can take like 2 questions before we. Anybody, and then Jeff will be around. Yeah, Sean, please.
Before you do that, I want to add something real quick.
Yes,
So,
thank you.
2 weeks ago, I heard something interesting. Brandon Turner and Bigger Pockets?
Yes,
I don't know if
Brandon
y'all
Turner,
haven't seen
Bigger
Bigger
Pockets.
Pockets, check it out.
Bigger Pockets is the biggest investing forum in the U.S. We've
For real
been working
estate?
with them. Yeah, for real estate investing. Yeah, so if you're out there, check out. Great resource.
So he said something really interesting that I hadn't heard before. He said there's like 4 ways to make money in real estate. One of them is wholesaling. If you want like really quick, small amounts of cash, there's wholesaling. If you want to make bigger amounts of money that take a little bit longer time, there's flipping. If you want to make more money than that, it takes longer time, you can get into like development of like new houses. But to build long-term wealth, long-term passive income wealth is done through syndications.
Yeah, and I think it's interesting. That's why we talk about partnership a lot. Is there are a lot of people that come in here and want to invest in real estate, but don't want to do the unpleasant parts of. They want to be landlords, but they don't want to be property managers.
Absolutely.
Yeah.
And going back to the development part, so when I said that Knoxville is not transacting those multifamily assets because the basis is so low, they've got so much cash flow, why would they get rid of that golden goose essentially? Now what we're seeing in this area is if you can find a development play, that's what I'm looking for, and that's what we're doing is development plays. So talking with Sean, his assets that he's buying are not here in the area. They're at a place where you still have a value add component, and you're seeing those opportunities present themselves.
Sure.
And we're just not seeing that turnover here.
Yeah, and I will just wrap this up with, I had a conversation with Rob Chavez that founded Grid, and I was talking to someone, experienced operator in Atlanta. She'd been in the real estate game for 20-something years. She had this great syndication, and Rob's like, what's the deal? What's the deal? Why is it a great one? He's like, go ask her, why is it a great deal? Explain it to me. Like in plain language. And he said, here's what this is. If you're looking at multifamily, you're looking at syndication, any of this, all it is just you added a zero. It's the same exact thing. If you understand what an undervalued house in your neighborhood looks like, oh, that one's selling for 200, but it should be 300. It's not different when it's something else. And he said they're all the same when you break it down. Is it new construction? Is it a fix and flip? Is it a development play of some kind? Or maybe it's, well, the upside is we're going to build another building. He's like, but break it down into basic concepts like that. I see Sean nodding. If they can explain it like that, like, you should be able to understand. Good deals often make sense. Not all of them. Sometimes there's really sophisticated deals, which is why we have things like accredited investors. Because it's a deal where, like, you have to have a level of sophistication to understand, okay, but walk me through why this deal with these historic tax credits, why this crazy niche thing works. It doesn't sound like, but those aren't for the general public because you could get scammed. You wouldn't know, like, are they giving you accurate information or not? So when I'm looking at these deals in general, right, me coming in here and turning a Class B asset into a Class A asset is just like a BRRRR strategy, right? I'm gonna fix it up, I'm gonna rent it out, I'm gonna refinance and repeat. It is the same thing, it just sounds different because it's a big multifamily property.
Perfect. Yep.
Yeah, thank you. Hey, can we get a big hand for Jeff for coming out? If you want to, let's all stand up really fast. We get a picture here for the. If you want to come out and actually learn about one of these and talk it through, we're going to do coffee, donuts, and deals. It's an incredible experience. Andrew's Coffee Lounge on August 22nd. Just come out here and check it out. And we usually network for about 45 minutes, and then we'll sit down and we can go deep and we can walk you through kind of step by step. Hey, let's break down, like, what are we looking at? What's the return? Why would I want to? Like, walk me through how this deal makes sense. And if you really are just getting started, please come out to Investing 101. I think it's one of the best things that we do. I'm so glad that we added it. Cory, what are your last words, bud?
No, just thanks everybody again for coming on out. Our September meetup next month is actually going to be the fundamentals of new construction. So leaning
There
into
you go.
talking about development and everything. So next month we're really going to be breaking down just the fundamentals of new builds. We're seeing a lot of that boom here in this area. So what do those opportunities look like? Very excited to really dive into that one.
Yeah. Thank you, Jeff. Any last words for us?
Thanks for having me.
Yes. If you haven't been before, let's get a picture. We'll freeze this real fast. If you haven't been before, I'm a huge believer in new construction. I am so gung-ho about it. I'm really excited for us to have that next month. What's that, Dalton?
I'll take an actual one in a minute.
Okay. Awesome. Hey, thank y'all. Thanks for coming out.